The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Ben Boulos. These are your headlines. SpaceX reportedly plans an IPO share price of $135, targeting a $75 billion raise. But Morningstar analysts suggest its valuation is massively inflated. David Solomon, CEO of lead left bookrunner Goldman Sachs, gives CNBC his take on market conditions.
I do think we're in a period, and I know when I say this, so I'm pausing for a second to say it, but I know when I say it, it will get quoted. But I think it's definitely true. It's something for us to reflect on. We are definitely in a moment where there's more greed than there is fear.
The US proposes new tariffs on 60 countries over alleged failures to ban imports made with forced labour, with the EU and China on the list.
Zara owner Inditex backs its full-year outlook after posting a strong start to summer, reassuring investors that sales can stay resilient amid cost of living pressures.
SpaceX reportedly plans to price its IPO at $135 per share, according to a single source speaking to Reuters. That would raise $75 billion and give the rocket and AI firm a valuation of $1.75 trillion. The reported move to fix an IPO price this early, even ahead of the roadshow and book building, is out of step with normal practice. CNBC has reached out to SpaceX for comment. Well, SpaceX will still likely be the largest IPO ever by a wide margin, but estimates on its valuation have varied widely in the run-up to the market debut. Morningstar analysts now say its true value is $780 billion, less than half of what the firm is said to be targeting. Earlier in April, it was reported the Elon Musk-led company was looking for more than $2 trillion, with that falling to at least $1.8 trillion at the end of May. So a couple of points here. Normally we talk about a range for the IPO price and then it lands depending on demand. And now we're talking about a fixed price even before that book building process, before that real test of the market has taken place. But we know that there's been a lot of marketing already of SpaceX stock to would-be retail investors who hasn't received an email suggesting that there's retail stock out there. And if you are buying into it, what are you buying into? You're basically on board, strapped into that rocket with Elon Musk because he has controlled, thanks to the voting class of stock, very little say when it comes to the shareholders. And where exactly is it going? Is it going to the moon and back, or is it going in one direction? I think investors trying to work out based on this valuation, which, as Morningstar now points out, is effectively on their numbers. It should be 48% below what it is out there in the private market valuation.
I think what's interesting, the analysis coming from Morningstar, totally independent in terms of not being involved in the IPO process at all, which is quite hard to find actually among commentators because so many of the banks have some sort of part to play in it. But I think the point you make about the fundamentals of it, this is a company that's making losses. It's not got any clear timeline about when it will generate a profit. And actually at the moment, I think I'm right in saying the only part of the entire business that's making profit is the Starlink, the satellite arm, but that's more than offset by the losses that it makes in other bits like the XAI bit, which it absorbed into the wider company last year. I think it was last year.
Look, it doesn't matter what we say. You're quite right. It's being sold to every man and his dog, and it will get off the ground, and I'm sure they'll sell every single share, and it'll be fine. So it doesn't matter what we think the valuation is worth. Let's put that as a caveat. What I say next does not matter. It is a ridiculous, historically crazy valuation. It is completely nuts, and that's the Morningstar valuation, let alone the other one. Let's look at this in pure money terms, right? Because I like to look at these things compared with pure money comparisons. What is one of the most successful companies to come out of the dot-com bubble bursting? Amazon, yeah? Amazon is worth $2.8 trillion as of last night. It has 700 $217 billion of sales, right? Remember that, everybody. You do get your pen out if you want, get your Bic out, other pens are available. $2.8 trillion valuation, $700 billion plus in sales. This company has no profits, as you quite rightly mentioned, because Grok and XIA and Twitter, whatever you want to call it, is a pile of something at the moment compared with it. It just loses money hand over fist. $6 billion, I think was the last figure. This company has around about $18 billion of revenue. Now, it is growing. I'm not saying Starlink isn't amazing and SpaceX and the launching, it's fantastic. But the fact is it has $18 billion of revenue compared with $716 billion of revenue for Amazon. This one is being called up as high as $2 trillion of valuation, 1.8, 2 trillion, compared with Amazon at 2.8.
Yes.
Work it out, ladies and gentlemen. If you can't work it out with those numbers, then you maybe need to watch another channel. You're not watching the right channel. Do we need to move on?
Well, wireless has never looked so sexy, has it? I mean, there's a big multiple for wireless, which is effectively what you're paying for.
Goldman Sachs CEO David Solomon has downplayed concerns over the market's ability to absorb a string of huge AI IPOs this summer, saying there is a greed mindset on Wall Street, as opposed to when. Anyway, let's listen in.
I think there's plenty of liquidity in the system if the world continues to remain as optimistic. And I do think we're in a period, and I know when I say this, so I'm pausing for a second to say it, but I know when I say it, it will get quoted. But I think it's definitely true and something for us to reflect on. We are definitely in a moment where there's more greed than there is fear.
And for more on the booming AI space, let's cross out to Elaine in Hong Kong, who has a superb guest for us now. Aravind Srinivas, who is the CEO of AI startup Perplexity. Elaine, I'm very excited.
Yeah, thanks, Steve. So, Aravind, it's great to have you in the Hong Kong studio with us. So, at Computex yesterday, you announced your hybrid local cloud inference system. But I understand you also have an announcement to make on a partnership. If you can tell us more about that.
Sure. So, we believe that the future is going to be a hybrid of server and local for agentic inference. The data center is coming to your laptop. People are tired of token maxing and paying $500 million a month on, whatever frontier model tokens that are running on the server. I think what you really want long term is really high token value per watt per user. And I think the best way to do that is to orchestrate intelligence, accuracy, privacy, and costs all simultaneously. And that's an orchestration problem. And so that's why we built Perplexity Computer, which we think is an AI operating system. It takes objectives instead of instructions and puts together everything AI can do in one single unified system. And earlier, Perplexity Computer orchestrated across models, files, and tools. Now it can orchestrate across chips. That is the chip that's on your local computer, as well as the chips that are on the servers, like GPU racks. And that's the hybrid agentic inference that we announced yesterday with Intel. But we are chip agnostic, and we are working together with everybody, including NVIDIA on RTX and Apple on Mac. So I think that's the power of Perplexity. It's a neutral, model agnostic, chip agnostic orchestrator.
And you also have a partnership for your personal computer, your agent product for Microsoft now, if you can tell us more. So is that targeting enterprise customers?
That's correct. So both enterprise and consumer. So we announced a bundle of Perplexity Computer integrations with all of Microsoft 365 software. So first of all, there's another thing I need to introduce, which is the personal computer. So which is a version of Perplexity Computer that connects your local files. It lives inside your desktop. So it has access to all your local files, your local apps, and so on. And we made a big announcement on the Mac ecosystem about a month ago. And obviously, a lot of our Windows users were like, we want this, we want the same thing. And so we first started off with Office 365 integrations. And then tomorrow, we're going to announce a version of personal computer for Windows. And so it'll do everything that we did on Mac on the Windows ecosystem. And so that's what we are excited about. We're going to put out a wait list, and we're going to be launching it later this month.
Okay, so it'll be this month that you're looking to roll that out.
The wait list is going to go out tomorrow, and the actual app will be shipped later this month.
And, like for companies like Microsoft and Apple, they have their own ecosystem or hardware. So For Perplexity, how does not having your own ecosystem or hardware impact the long-term viability of your product? Is there a risk that these big ecosystem players could favor their own AI products down the line?
I think they absolutely will try to build their own AI systems, but we believe we are building the most versatile operating system by making it work across different models, across different chips, across different traditional operating systems, different hardware providers, different laptops, and that hybrid neutral orchestration layer is what we're building, and that allows us to balance all these different objectives simultaneously. Now, for example, like you would want to specifically focus on Microsoft software inside Windows, but there's a lot of desktop apps and hardware advantages the Mac ecosystem has that a company like Microsoft wouldn't be able to focus on. Whereas Perplexity can do all of that. Like we can build models that can be very efficient locally on Mac Minis, as well as RTX, as well as Intel Arc, and all these all these different work streams allows us to build something far more versatile than any of these individual companies that are focusing purely on their own ecosystem.
Yeah, and also as more companies go deeper into AI agents now, I want to ask you about the competition and how you're differentiating yourself a bit more. So say if other companies were to copy your feature, what will still be hard for others to replicate?
I think the primary focus of Perplexity since the beginning has always been accuracy and model agnostic orchestration. So OpenAI and Anthropic are actually model providers inside Perplexity. So anytime their models actually get better, Perplexity as a product also gets better. Just to give you another way to think about it, Anthropic has made a tremendous amount of progress in their models since the beginning of the year. What has that led to for Perplexity is that 3 times revenue growth since just the beginning of the year. In 5 months, we have tripled our annualized revenue thanks to model advances that have been made by Anthropic. So it might look like we're competing with Claude or something, but what's actually going on is every time there's a competition at the model layer between companies like OpenAI and Anthropic, or every time there's a competition on the local chip layer between Intel and NVIDIA, or anytime there's a competition on the traditional OS layer between Apple and Microsoft, the biggest beneficiary of this is Perplexity, because we are orchestrating across all of these different providers, all of these different ecosystems, all of these different hardware providers. And so that's why our business is going really, really well.
And you mentioned OpenAI and Anthropic, with their IPO raise, these could well become the public market benchmarks for AI here. So down the line, what do you think will determine AI valuations more? Would it be users, revenue, the proprietary models or data?
I believe that whoever can provide the most token value per watt per user for the amount of power and watts you consume, how much value the output tokens you can generate in terms of economic value. Whoever is able to maximize this particular objective really well by balancing accuracy, latency, cost, privacy, and intelligence all together, they're going to win. That's what's going to win long term. And so it might feel like some model provider is making a lot of money because their models are very expensive and they're running on servers, but that's a short-term revenue growth. What you really care about is sustainable, durable advantage. And we believe that this is an orchestration problem. And that's what we're going after. And so we believe that by solving that, we'll be building a pretty valuable company that has a durable long-term advantage.
Yeah, and you talked a lot about AI spend becoming more efficient. I want to drill just more into where exactly that efficiency lies, because with more agents, there could also be more demand for compute, for
That's
CPUs, right, for memory. So where does it come from for you? Is it about because you're harnessing different AI models,
That's
or
right,
that the agents get to decide where it wants to perform the task locally versus servers, and how will that lower your requirement for?
That's exactly right. What you just exactly described it. So people are talking about being compute constrained, right? And so there is a lot of compute that's in everyone's homes, in their devices, in their laptops, and that's not actually being utilized for inference right now. All agentic inference is running on giant data center build-outs. And then we don't have enough data centers, and that's often cited as the reason that we're compute constrained, And that's often cited as the reason for rise in token pricing, and then people spending $500 million like a month on coding tokens. That's because you're not actually utilizing a lot of compute that's already out there in the world, but a little more decentralized. AI inference doesn't have to be all centralized in like a bunch of data centers and servers. It can actually be a pretty good hybrid, especially when a lot of your daily tasks and workflows can even be run with models that can run locally on your own laptops and devices. So I think that compactness, like when to use a frontier, depending on the sophistication of the task, and when to use a non-frontier but still a pretty amazingly capable model that can fit on your local compute. Being able to figure that out is essentially an orchestration problem, multi-model routing across different hardware stacks. And so that's the problem you got to solve to fix this compute constraint that exists in the world today.
Yeah, and a quick last one for you as well. I want to ask about the copyright issues and some of the legal battles we have in the industry between publishers and AI companies. I know you've said that you believe there's no copyright on facts and you'll let the court decide. But what would that economic relationship between AI companies and publishers look like if it's working properly?
I think we have put forth a bunch of ideas on this. Like what we really want to get to the bottom of is the framework, right? We are coming with this mentality that what's more important is for people to get knowledge and facts. And I think everyone has a different opinion. Like obviously publishers have their own opinions here. We actually just want to respect the legal process in this case, particularly in the case of whatever CNN put forth last week, and we'll let the process play out. I think we believe our position is very strong. We've been having a very consistent position on this since the beginning of the company, which is our goal is to provide accurate answers. People want that. If they did not want that, they wouldn't be coming to our products. And we want there should be no monopoly on facts, right? Like if somebody, let's say if Newton wanted a monopoly on the theory of gravity, or Einstein had a monopoly on the theory of relativity, I don't think the world would be a good place, right? There should be an open dissemination of facts and knowledge and truth. And that's what our company tries to provide to people. And people see the value in that service, and that's why we have a lot of users.
Okay, a very important conversation. Thanks for joining us today. That's all the time we have, and that was Aravind Srinivas, the CEO of Perplexity. And now it's back to you.
Elaine, thank you very much indeed. Thank you for being with us, and stick around because still to come on the show, the US proposes new tariffs on 60 countries over alleged failures to ban imports made with forced labour. We'll tell you who's on the list, and there are some big names. Plus, Inditex posts strong sales growth at the start of its second quarter. Charlotte will have all the numbers. And we'll be talking all things European competitiveness with Hero Capital's Nick Clegg. Don't miss that conversation. It's coming up at 8:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
European business leaders have the same level of ambition as those around the world. That's according to Anthony Goodman, Co-Chief Executive Officer, Goldman Sachs International, who spoke to Carolyn earlier this morning.
We are optimistic about Europe. We continue to be. We've been consistently. We're operating across 23 different countries, 29 different offices. At any point in time, the European business represents between 20% and a quarter of of our global revenues, and we continue to see real growth, and we see growth across our businesses. I'd say on the M&A front, on the investment banking front in Europe, just think about the clients that we have here at this conference and the amount of ambition they're showing. We saw, Zurich Insurance make a $15 billion acquisition of Beazley. We saw Santander acquire Webster Financial in the US, Generali, Natixis. I could go on and on and on. So I think it speaks to the fact that European business leaders, have the same levels of ambition as those around the world, and they're executing them, and we're excited about that.
Carolyn has more from the Goldman Sachs European Financials Conference in Zurich. Carolyn, good morning to you. What are some of the big takeaways from your perspective?
Look, a lot of optimism here, and let's see how our next guest feels about the European banking space. He knows a thing or two about that. His name is Chris Hallam. He is head of European Banks Research at Goldman Sachs. How are you?
Yeah, great. Thanks so much for having me here.
Look, a couple of months or weeks ago, rather, we saw the European banks being sold off quite heavily. Concerns about AI disruption, concerns about private credit, the energy crisis, and they've recovered since. But at the time, Chris, you actually said they were sold off disproportionately. Why is that?
I think it's a good question to start with. I think at the time there was clearly value in the sector. The sector was inexpensive versus its own recent history versus European equities versus US banks. The question was, we have value, do we have resilience? And the sector had fire drilled periods of uncertainty previously. Think 2022 with Ukraine, 23 with Credit Suisse and Silicon Valley, and 2025 with Liberation Day. So the resilience that we typically think about for banks is capital and liquidity. And clearly both those metrics are very, very good for the banks right now, and that wasn't so much of an uncertainty. I think what investors spent more time thinking about was the resilience in the P&L itself. So profitability was higher. That meant banks had more ability to absorb any sort of first-line losses. But then the last point would be, obviously, as you think about their business model, they've de-risked some of the more risky areas of lending, and so their back book was less risky. So good capital, good liquidity, good P&L resilience, and a less risky back book. And then to come back to that liquidity issue and capital issue, because they had that flexibility, that meant that if there was a bounce in activity, they were well positioned to be able to be there for clients and facilitate whatever those clients might need. Then the last thing to think about is what was happening at the time, right? Rates expectations were going up and credit spreads were widening. And if you do those two things together, you can kind of see, well, net interest income would go up from higher rates and potentially credit losses would increase as well. But the net effect of the two is more or less neutral. So you had a sector that was sold off, we had EPS upgrades, and we had a resilient backdrop. And that's where we sort of said, actually, look, the value is there, but more importantly, the resilience is there. And that's what really matters in this kind of period.
Right. And now the sector's come back, almost back to February 7th high. You were right with your call, the fact that they were undervalued. But let's talk about some of the issues you mentioned here. Higher rates, higher for longer. It's not going to be the same boost to the banks as we saw a couple of years ago, right? It's only a marginal impact this time.
Yeah, I think that's absolutely true. To go from minus 50 basis points policy rate to 400 basis points was a big and dramatic move. Just moving from minus 50 to plus 50 alone is really reasonably dramatic. What you're seeing here is a move, let's say 70 basis points priced in, so 2 to 3 hikes, right, over the next 6 to 9 months. That's clearly net positive. There's a discussion here in a big way, I think, about how much of that will be passed on to savers. Clearly the banks won't retain all of that uplift, but it will, all else equal, be positive for profitability. What's interesting for the banks is so much of the banks are now more reliant on what we call liability income. So making money off deposits rather than traditional lending businesses. That's much more capital light, and it's no credit risk. So a unit of revenue growth today is less risky and more accretive to returns than a unit of revenue growth in the last 10 to 20 years.
If this energy crisis lasts a lot longer than we expect, and there's still no solution when it comes to the Strait of Hormuz, are you concerned about credit losses in the industry? You said before that banks were a lot more resilient, but they haven't seen this kind of disruption before.
I think so. Clearly in COVID, we saw a big increase in credit losses, some of which was sort of anticipatory credit losses. What you've also seen today now with new accounting rules is banks have to pre-provision for what they think might happen in the future, these macro adjustments and model adjustments. That's already been happening in the first quarter. If we see an extended period of uncertainty, that will happen again in Q2 earnings. So you're starting to see some of that feed through. I think the other part of the question is it's not the same for every part of Europe, right? We're quite a heterogeneous banking sector. So some parts of Europe, think about the Nordics, less sensitive to energy shocks. Some parts of Europe, think periphery, Ireland, more sensitive to higher rates. Different lending models, some more corporate, some more household mortgages, etc. So it won't be even. And I think when you're seeing on an intra-sector basis, as those themes play out and some of the divergence we've seen between sort of winners and losers since February the 27th.
Private credit, are these concerns overblown?
That was definitely a big topic of debate for the banks prior to Feb 27th and sort of got overtaken by the stuff you just talked about. I think what people have learned a little bit on private credit is different for the private credit companies versus the banks themselves. So simplistically in Europe, we have a handful of banks which have somewhere between 3 to 4% of their loan book in lending to private credit funds. But those private credit funds, the debt issued by the banks is only a part of the actual fund itself, and so the banks are relatively insulated from the losses that those funds may absorb. You've seen a few CEOs and CFOs go on the record to talk about the fact they've really not lost any money in this business for quite some time. So I think investors in general in our discussions are relaxed about the risk of credit losses from private credit. The question though is the growth, because as you know, private credit had been growing incredibly quickly.
Sure.
And now maybe that narrative is changing slightly. And so as an analyst or as an investor, what you had penciled in for 3 years forward on your private credit line, maybe that the volume number there needs to change, but not necessarily the credit loss number near term.
Mm-hmm. Let's get to the other sore point, and that would be AI disruption. Which parts of the businesses, when it comes to European banks, are actually going to be disrupted, and which parts are actually going to be, become more valuable?
Yeah, I mean, to be clear, we definitely think banks are winners in sort of the whole AI debate. We did a big report in February. We think if you had to put a number on it, which I think everyone should try and do in this environment, we think it's about 200 to 300 basis points improvement in returns from the multiple different layers of cost which banks are able to address by using some of the newer technologies, which I think has dramatically changed in the last 3 to 6 months, frankly, when you speak to some of these management teams. On the risk side of things, what we've seen play out perhaps more in the US as a debate is the extent to which deposit behavior will change, because we'll have a tool in our pocket which will enable us to optimize our deposit saving strategies. We haven't really seen that in Europe, but it's so early days with this new technology. So I think it's something that people are alive to. You look at the type of business model, most banks have loads of liquidity, so they don't necessarily need those deposits. There's also not a huge amount of credit growth, so they're not trying to pull in new deposits to fund the loan growth. So there's specific banks, you could argue, that are more at risk because they have slightly less excess liquidity, but in general the sector is very well provisioned with liquidity, so not necessarily so susceptible to deposit betas spiking up.
Chris, got to talk to you about European banking consolidation. There's so much euphoria around it, lots of hopes. Is it actually going to come to fruition? Specifically that one deal? I know you can't necessarily talk to the details of that, but it needs to happen, right? To make the European banking union a reality.
I think, so first and foremost, we've had a huge number of deals be successful in this sector over the last 9 to 18 months, right? And generally smaller bolt-on deals. We always talk about 3 buckets: big, cross-border, difficult to do; in-market consolidation, super attractive, but there aren't so many opportunities; and then cross-border bolt-ons. There's loads of opportunities and there are loads of deals getting done. Now, there are some cross-border deals getting done as well. Erste Bank had a deal in Poland which closed at the beginning of this year. We've had a few others announced.
But they're smaller ones, right?
There's not always small in the context of some of those banks. I think Erste Bank Poland was probably the biggest in cross-border in 20 years. But you're right, many of them are smaller bolt-ons. Then I think the bigger deals we've seen in Spain, we're seeing in other countries, are bumping into domestic opposition. And that's not just true for cross-border. We're also seeing in-market consolidation in some markets bump into political opposition. So I think we're seeing a very, very strong level of activity, but with some high-profile speed bumps, if that makes sense.
And what some of the banks are doing, or even thinking about, Santander, for example, they're looking west. They're looking towards the U.S. We know UBS wants to bulk up in the U.S. Is that a viable growth path? If you can't find it here in Europe, got to look west?
Well, I sort of defer here to my colleague who's co-chair of FIG Banking, who was on stage yesterday talking about this exact topic. I think when you think about Santander, for example, they already have a presence in the US. Them, Barclays, UBS, banks that already have a reasonably large onshore presence in the US, for them it makes sense to be potentially looking at or doing deals there to build out what they already have. For other banks to go sort of clean slate into the US, that is a challenging market. It's a very competitive market. There are some very big, very strong banks over there. And there's also a very sort of, entrenched regional network as well, which is difficult to compete against. So we would say banks that are already there building out make sense. Banks that are not already there going in, less probable.
Chris, finally, very briefly, you say the sector is still a buy, trading at 10 times. However, in terms of the individual names, give us some ideas here.
I think the first thing, the problem with individual names is it all depends on, what's the macro in 2 or 3 months' time. If you tell me that, we can tell you which of the banks are going to do less well.
But go ahead.
I think if you try and take a step back and think about more idiosyncratic stories, we have 2 stocks on our European conviction list in the bank sector, HSBC and BBVA. Both of those banks are linked to growth outside of Europe. For HSBC, Georges will be on stage in a few minutes. It's the Hong Kong wealth story, is a huge part of that investment narrative. For BBVA, it's the Mexican growth story, huge part of that narrative. So trying to find idiosyncratic elements of equity stories that aren't so dependent on a broader oil price or European macro narrative is interesting right now.
Chris, so great to talk to you. Thank you so much for your insights here. Chris Hallam from Goldman Sachs. Plenty more coming up from this conference here in Zurich in the next hour.
Oh, brilliant, Cara. There are two things I love about your coverage. One, it's brilliant, and two, I don't have to do any work. So thank you for both.